The foreign exchange market, often called Forex or FX, is the largest financial market in the world. Imagine a massive global marketplace where currencies are traded instead of goods. It doesn't have a physical location. Instead, it's a vast network connected electronically. This market operates 24 hours a day, 5 days a week across different time zones. When you hear about the US dollar strengthening against the euro, this is where that change happens. It's a dynamic environment where one currency's value is constantly compared to another's. At its core, Forex trading involves buying one currency while simultaneously selling another. Currencies are always traded in pairs, EUR/USD, euro versus the US dollar. The exchange rate tells you how much of the quote currency you need to buy one unit of the base currency. For example, EUR/USD equals 1.1000 means $1.10 to buy 1 euro. Traders speculate if rates go up or down. Think of it like planning an international trip. Traveling from the US to Europe means exchanging dollars for euros. Forex traders do the same but on a much larger scale and much more frequently. Their goal is not to travel, but to profit from changes in exchange rates. The beauty of the Forex market is its accessibility and liquidity. The fundamental principle behind every price fluctuation is the timeless economic law of supply and demand. This simple concept is the engine that powers the entire Forex market. In the context of Forex, supply refers to the total amount of a specific currency that is available for sale in the market. When the supply of a currency is high, it means many people or institutions are trying to sell it. This could be due to a country's central bank printing more money. A high supply with no corresponding increase in demand puts downward pressure on the currency's value. Essentially, when something is abundant and easy to get, its price tends to fall. It's like a farmer's market flooded with too many apples. Sellers have to lower their prices to attract buyers. On the other side is demand. Demand represents the total amount of a specific currency that traders want to buy. High demand means many market participants are eager to acquire that currency. This could happen if a country's economy is strong, its interest rates are high, or it is seen as a safe haven. When demand outstrips supply, its value is pushed upward. The exchange rate you see is the equilibrium point where supply and demand meet. However, this equilibrium is never static, it's constantly shifting. New information enters the market every second. An economic report, a political announcement, a change in market sentiment. Each piece of news can cause traders to alter their perceptions, leading them to either buy or sell. This continuous tug-of-war between buyers and sellers is what creates the price movements we trade. So, what causes these shifts in supply and demand? One of the most significant drivers is interest rates. They're set by a nation's central bank. High interest rates let investors earn more by holding that country's currency. Example, Bank of England raises rates. Investors may sell US dollars, sell euros, and buy British pounds. That increased demand pushes the pound's value up versus other currencies. Economic data releases are another critical factor traders watch. Inflation, employment numbers, manufacturing output, gross domestic product. A strong GDP report typically increases demand for its currency. High inflation is a double-edged sword. It might prompt rate hikes, but runaway inflation signals instability. Political stability and geopolitical events also move currencies. Stable politics equals safer investment equals stronger currency demand. Political turmoil, elections with uncertain outcomes, international conflicts. During such times, traders flee to safe haven currencies, US dollar, Swiss franc, Japanese yen. Flight to safety raises demand and spikes those currencies' values. Finally, market sentiment and speculation can become self-fulfilling. If many believe the Eurozone will weaken, traders start selling the euro. Selling increases euro supply, pushing its price down. Herd mentality creates trends based on psychology more than fundamentals. Let's walk through how supply and demand impact an exchange rate. Imagine EUR/USD trading at 1.1050. At this price, buyers and sellers are perfectly balanced. The European Central Bank releases a surprisingly positive economic forecast for the Eurozone. Thousands of traders believe the euro is undervalued and decide to buy euros. Their collective action tips the scales toward higher demand. Buy orders consume available sell orders at 1.1050, depleting supply at that price. To find new sellers, the price nudges higher to 1.1051, where new sell orders wait. This continues like a chain reaction as price climbs from 1051 to 1052 to 1055. Two things happen. Rising price attracts more trend followers, adding fuel to demand. Higher prices entice euro holders to sell for profits, introducing new supply. Price rises until reaching new equilibrium where buyers equal sellers again. Currency prices reflect the global battle between supply and demand. High demand pushes prices up, while high supply pushes prices down. This is influenced by interest rates, GDP, geopolitical events, and trader sentiment. Understanding what causes market participants to buy or sell helps anticipate price movements. Your trading journey starts with grasping this principle, the foundation of all trading strategies.